Imagine you're walking into a hospital. Before any doctor prescribes a drug or decides on surgery, they usually want two things: pictures and lab results. That is exactly what the Diagnostic Imaging and In Vitro Diagnostics, or IVD, block does. On this first slide, let's get clear on what diagnostic imaging and in vitro diagnostics actually are. Diagnostic imaging is all the big machines that take pictures inside the body: MRI and CT scanners, X-ray, ultrasound, PET, and mammography. In vitro diagnostics, or IVD, are tests done on blood, urine, or tissue outside the body. That ranges from simple blood counts to very advanced genetic and cancer tests. Together, this block is the eyes and lab work of modern healthcare. Doctors rely on these tools to detect disease early, choose the right treatment, and see whether that treatment is working. Financially, this is a large and important space. The IVD market is around $105 to $110 billion in 2024 and is expected to reach about $150 billion by 2030, which is roughly 5 to 6% annual growth. Imaging equipment adds another $50 to $55 billion today, heading towards $75 to $80 billion by 2032. So combined, you're looking at well over $150 billion in yearly revenue, growing steadily in the mid-single digits. On this slide, you see the market size and growth more visually. The first chart shows the in vitro diagnostics market by region. It starts around that $105 to $110 billion level in 2024 and climbs toward roughly $150 billion by 2030. Different colors show North America, Europe, Asia-Pacific, and other regions, so you can see both the total growth and how much demand is shifting toward Asia and other developing markets. The second chart is the diagnostic imaging equipment market. It shows global imaging equipment moving from roughly $50 to $55 billion in 2024 toward about $75 to $80 billion by 2032. Again, that's around 5% annual growth. The key takeaway from these two visuals is simple. This is not a niche. Diagnostic imaging and IVD together are already huge, and they are expected to keep compounding at about 5 to 6% a year for a long time. Now let's talk about who actually operates in this block and what they sell. There are imaging equipment manufacturers, often called OEMs, that build MRI, CT, X-ray, ultrasound, mammography, and PET scanners, plus the software that runs them. Next, you have IVD instrument and reagent manufacturers. They make the lab analyzers for chemistry, immunoassay, and molecular tests, and also the disposable reagents and cartridges those analyzers consume. Central laboratories and diagnostic chains are another key group. They own large labs and run huge volumes of tests for hospitals, clinics, and insurers. Then you have specialty and genomic test developers who design proprietary assays like advanced cancer screening or prenatal genetic tests. Finally, there are point-of-care and rapid test players whose devices and strips are used in clinics, pharmacies, or at home. What they sell is a mix of hardware, consumables, services, and software. Customers are mainly hospitals and health systems, lab chains, clinics, public health programs, and pharma and biotech companies. Patients are the end users, but most purchasing decisions are made by hospitals, lab operators, and payers such as insurers and governments. On this slide, we anchor the block with some real-world names. These are examples only, not stock recommendations. Platform leaders include GE Healthcare Technologies in imaging, Siemens Healthineers in both imaging and lab diagnostics, Hologic in women's health imaging and diagnostics, Roche with a large diagnostics division across immunoassay and molecular testing, and Abbott with strong positions in rapid tests, point-of-care systems, and core lab analyzers. On the services side, Quest Diagnostics is one of the largest U.S. lab chains, running billions of tests each year and generating over $9 billion in annual revenue. LabCorp is another big lab and drug development player. Bio-Rad supplies instruments and quality control reagents used in labs worldwide. Then you see two emerging challengers. Exact Sciences developed Cologuard, a non-invasive stool DNA test for colorectal cancer screening, historically priced around $599 compared with roughly $20 to $30 for a standard stool test. Guardant Health focuses on liquid biopsy, using tumor DNA and blood to detect and monitor cancer. The Reuters headline on this slide, showing GE Healthcare buying a software and imaging company, is a reminder that consolidation and ecosystem building are constant themes in this space. Next, let's look at how these companies actually make money. The first model is capital equipment plus consumables, often called the razor and razor blade model. A company sells an MRI scanner or a lab analyzer once, and then earns recurring revenue from reagents, test kits, cartridges, and contrast media, plus maintenance contracts and software updates. Imaging OEMs and core lab analyzer vendors use this model. The second model is per-test lab services. Central labs such as Quest and LabCorp are paid each time they run a test. Their revenue depends on test volume and the prices they have negotiated with insurers, hospitals, and governments. The third model is proprietary and specialty tests. These include genomic, oncology, and prenatal tests that can change treatment decisions. They often command premium reimbursement but rely heavily on intellectual property, strong clinical evidence, and payer approvals. There are also point-of-care tests in clinics, pharmacies, and at home, which have higher price per test but lower volume per site, and a strong convenience angle. On the economic side, reagents and tests often carry gross margins in the 55 to 70% range. Hardware is lower margin, but it enables those high-margin consumables. Mature, scaled players can reach operating margins of 15 to 25%. Capital needs are significant up front, but once the installed base and networks are in place, each additional test is relatively cheap, which supports attractive returns. This slide zooms in on how often these tools are used and what typical pricing looks like. Hospitals and large labs use imaging and lab tests all day, every day. Many analyzers and scanners run 24 hours a day. Once a hospital or lab chooses a platform, they usually keep it for years. Staff are trained on it, IT systems and quality controls are set up around it, and switching would require new validation and retraining. That is why these customer relationships are very sticky. In terms of pricing, think in 3 layers. At the per-scan level, in the US, the average MRI bill is often around $1,000 to $1,500, but the actual range goes from roughly $400 up to well over $10,000, depending on the body part, the site, and the insurance. You can see those ranges in the MRI cost table on this slide. For lab work, a standard blood panel might bill tens of dollars, whereas a specialty cancer or stool DNA test, such as Cologuard, historically has list prices in the $500 to $600+ range. For manufacturers, reagents and tests often have 55 to 70% gross margins. Lab operators, however, work on thinner margins once staff and overhead are included, so they are very sensitive to volume. Now let's talk about how demand is evolving. The first big driver is demographics. Aging populations and more chronic disease mean more blood tests, more imaging, and more monitoring. At the same time, emerging markets are building new hospitals and labs, which is widening the customer base. The IVD market by region chart on this slide shows that growth is not only in North America and Europe, but increasingly in Asia Pacific and other regions. After COVID disrupted routine screening, many labs have seen volumes rebound as patients catch up on deferred tests. There is also higher awareness of preventative screening in areas like cancer and cardiovascular risk. Over the last 3 to 5 years, more people have started using home sampling kits and direct-to-consumer testing, especially in higher-income markets. Hospitals and payers are more focused on cost-effectiveness, preferring tests that clearly change patient management. Looking ahead 3 to 5 years, we should see more personalized, risk-based screening programs that use combinations of imaging, lab tests, and genetics, and a continued shift of some testing from hospital labs to large central labs and to home or near-patient settings. This slide explains how the block behaves through economic cycles and where AI fits in. Diagnostic imaging and IVD are moderately defensive. People still need tests for infections, cancer treatment, and chronic disease, even in a recession. However, some elective or purely preventative tests and scans can be delayed, so growth slows when economies weaken. If disposable incomes or insurance coverage fall, out-of-pocket tests and elective imaging are often postponed, and payers become tougher on approving new, high-priced tests. If interest rates stay high, hospital capital budgets for big MRI or CT upgrades can be pushed out, and labs with heavy debt may slow expansion. Rising input costs for reagents, logistics, and energy can squeeze margins where payers cap prices. Tighter regulation raises approval timelines and compliance costs, which favors large, well-resourced players over small entrants. On the technology side, AI tools are increasingly used to assist radiologists in spotting abnormalities on scans and to help labs flag abnormal results. The AI in medical imaging chart on this slide shows how spending on AI applications in imaging is projected to rise sharply over the decade. These tools require upfront software investment, but they can increase throughput and reduce errors, supporting margins over time. Here we focus on structural changes and who holds power in the value chain. Customers now expect more convenience. Patients are getting used to home collection kits and to checking results through digital portals. COVID highlighted how central testing is to health systems, and that awareness is spilling into cancer and cardiovascular screening. New channels are emerging: tests ordered online, collected at pharmacies or at home, and processed in central labs. Portals and apps that let patients see results and book telehealth follow-ups, and bundled screening packages offered in corporate wellness or primary care networks. Power is shifting from standalone hardware and one-off tests to installed ecosystems that combine instruments, reagents, software, and data. When a lab signs up to such a platform, the vendor enjoys very high switching costs and recurring revenue. Payers and regulators increasingly demand strong outcome evidence, which favors large, evidence-rich companies and big lab chains over smaller niche test makers. At the same time, lab consolidation means a few large chains and hospital networks gain more bargaining power with both suppliers and payers. The Reuters acquisition headline, together with the AI in imaging and IVD growth charts, visually reinforces this story of consolidation, digitalization, and scale. Finally, let's look ahead and think in scenarios. In the near term, over the next 1 to 2 years, the basic model of instruments plus high-margin reagents and per-test fees remains intact. COVID-specific testing revenues continue to shrink. Volumes are supported by catch-up in deferred screening, early AI tools used as add-ons, and ongoing build-out of basic imaging and lab capacity in emerging markets. In the medium term, 3 to 5 years out, diagnostics remain a priority within healthcare budgets, because early detection is usually cheaper than late-stage disease. Recurring consumables and service stay the main profit drivers. Some low-value tests that do not clearly change treatment decisions face price pressure or are de-emphasized in guidelines. Risk-based, personalized screening, wider use of liquid biopsies, and more integrated diagnostic networks all start to scale. In the long term, 7 to 10 years out, structural drivers like aging and chronic disease continue to support demand, and diagnostics remain central to value-based care. Some one-size-fits-all screening protocols give way to more personalized pathways, which can reduce low-value test volumes. Regions with aggressive price controls or volume-based procurement may see lower per-test pricing and margins in commoditized areas. We may also see AI-native imaging suites, more home and wearable diagnostics feeding into central labs, bundled diagnostic therapeutic ecosystems, and further consolidation into a handful of mega platforms. Putting this into 3 scenarios. In a bull case, governments and insurers push hard on early detection. AI and advanced diagnostics prove their value. Emerging markets ramp up, and this block grows at the high end of expectations, with excellent returns for platform owners. In a base case, diagnostics remain a steady, guideline-driven compounder with mid-single-digit to low double-digit earnings growth for leading players. In a bear case, fiscal stress, tough tenders, restricted reimbursement, and slower AI rollout push growth down to low single digits and squeeze margins, especially for smaller or less differentiated players. For any company you study in this block, the key questions are: is it a platform owner with strong, recurring, evidence-backed revenues, or mainly a commodity supplier exposed to price pressure? And how diversified is it across tests, payers, and technologies versus being dependent on just one niche?